For decades, economic history offered a bleak lesson for oil-rich states. Countries blessed with petroleum wealth often struggled to build diversified, productive economies. Economists labeled this pattern the resource curse. Easy revenue weakened institutions, discouraged private investment, and locked states into dependency. From Venezuela to Nigeria, attempts to pivot away from oil usually ended in stagnation or crisis. Saudi Arabia appeared to fit this model perfectly. Its modern economy was built on oil rents funding, public employment, subsidies, and political stability. Private sector productivity remained limited. Labor participation was low, and the state acted as the primary economic engine. Earlier reform efforts, stretching back to the 1970s, produced administrative reshuffles rather than deep structural change. When Vision 2030 was announced in 2016, skepticism was immediate. Analysts argued the plan relied on oil money to escape oil dependency contradiction in terms. Megaprojects like NEOM were widely mocked as extravagant symbols rather than viable economic engines. Social reforms were seen as destabilizing, not developmental. History reinforced these doubts. Most oil exporters attempted diversification only after prices collapsed, forcing them into debt and austerity. Critics warned Saudi Arabia would follow the same path, just at a larger scale. The consensus was clear. Ambition aside, the historical record suggested failure was the most likely outcome. What many critics missed was that Saudi Arabia entered its reform era from a position few oil states ever enjoyed. Unlike countries forced to diversify after fiscal collapse, Saudi Arabia still possessed vast foreign reserves, low sovereign debt, and full access to global capital markets. Historically, successful structural transformations from Meiji Japan to post-war South Korea began under conditions of relative financial stability. Saudi Arabia quietly met that prerequisite. Another overlooked factor was timing. Vision 2030 was launched before oil demand collapsed, not after. This allowed the state to use oil revenues as venture capital rather than emergency funding. In historical terms, this resembled early industrializers that reinvested surplus rents into future capacity instead of consumption alone. The distinction was subtle, but critical. Centralized political authority also mattered. While often framed purely as a liability, it allowed Saudi leadership to pursue long-term plans without electoral cycles or fragmented veto points. Historically, late industrializers frequently relied on strong central states to coordinate investment, infrastructure, and labor shifts at scale. Saudi Arabia also controlled land, capital, and labor policy simultaneously, an institutional alignment rare in modern economies. This made nationwide transformation administratively possible, in a way many democracies struggle to replicate. In short, critics judged Saudi Arabia by the failures of others, while overlooking the structural advantages that changed the historical equation. At the center of Saudi Arabia's diversification strategy sits the Public Investment Fund (PIF), which functions less like a traditional sovereign wealth fund and more like an industrial policy engine. Historically, states that industrialized late often used centralized investment vehicles to guide capital into targeted sectors. The PIF fits squarely into this tradition. Rather than attempting to build everything domestically from scratch, Saudi Arabia focused on acquiring existing firms, expertise, and global partnerships. This mirrors historical strategies used by countries like Japan, which imported technology and management before developing local capacity. The goal was not immediate profitability, but institutional learning. Sector selection also reflected historical lessons. Saudi Arabia prioritized tradable sectors: tourism, logistics, mining, and entertainment that generate foreign demand. This avoided the common mistake of over-investing in purely domestic, non-productive projects that inflate GDP without building resilience. Megaprojects, often criticized as vanity ventures, served a strategic role, accelerating infrastructure, attracting talent, and signaling long-term commitment. Historically, such signaling has been crucial in reshaping investor expectations during major transitions. The result was not random spending, but a coordinated, state-led blueprint rooted in well-established patterns of economic transformation. In historical terms, Saudi Arabia's social reforms were not a cultural side project, but an economic necessity. Economies that successfully industrialized almost always expanded their labor force and urban consumption base. Prior to Vision 2030, Saudi Arabia constrained both. Large segments of the populations, particularly women, were effectively underutilized, limiting productivity and growth. Reforms allowing women to drive, work more freely, and participate in public life mirrored earlier transitions seen in East Asia and Southern Europe. Where social liberalization preceded or accompanied economic modernization, these changes immediately expanded the domestic labor pool and reduced dependence on expatriate workers, a long-standing structural weakness. Entertainment and tourism reforms served a similar function. Historically, service sector expansion follows rising incomes and urbanization. By legalizing concerts, cinemas, and international tourism, Saudi Arabia began retaining domestic spending that previously flowed abroad. This shift increased internal economic circulation without increasing oil output. Crucially, these reforms were framed as economic tools rather than ideological commitments. This historical framing reduced resistance and tied legitimacy to measurable outcomes, like employment and growth. In this sense, social reform functioned as invisible infrastructure, less tangible than roads or ports, but just as essential to diversification. Measured historically, Saudi Arabia's results are best understood as early-stage indicators rather than final proof. Non-oil sectors began contributing a larger share of GDP, a milestone that many oil exporters never reach. Tourism arrivals increased, and entertainment became a domestic growth industry rather than an external expense. Foreign investment patterns also shifted. Rather than short-term portfolio inflows, Saudi Arabia attracted long-horizon capital tied to logistics, manufacturing, and services. Historically, this kind of investment signals confidence in institutional direction, not just commodity cycles. The Public Investment Fund expanded its global footprint, gaining influence and experience even when individual projects remained unprofitable. Past industrializers similarly tolerated early inefficiencies in exchange for long-term capability building. At the same time, not all initiatives succeeded equally. Some megaprojects lagged, reinforcing the historical reality that transformation is uneven and costly. The key historical takeaway is modest, but meaningful. Saudi Arabia moved from theory to execution, a transition many resource states never achieve. History offers a cautionary ending to nearly every ambitious economic transformation. Early momentum does not guarantee long-term success, and Saudi Arabia is no exception. Many of the country's flagship projects remain unprofitable, sustained by state funding rather than market demand. Historically, prolonged reliance on subsidies can harden inefficiencies instead of eliminating them. Centralized power, which enabled rapid action, also concentrates risk. Past state-led transformations from Latin America's import substitution era to parts of the Soviet bloc show how success can stall when feedback is muted and course correction becomes politically costly. Without institutionalized accountability, errors tend to scale alongside ambition. Another historical risk lies in global conditions beyond Saudi control. Industrial transitions often coincide with favorable external environments. A prolonged downturn in global trade, tourism, or capital flows could test the durability of non-oil sectors before they fully mature. There is also the question of social sustainability. Rapid reform creates winners and losers, and history shows that uneven distribution can undermine legitimacy over time. Economic diversification must translate into broad employment and income growth to remain politically viable. The historical verdict, then, remains open. Saudi Arabia has defied precedent so far. But history is clear on one point. Transformation is a process, not an event, and many failures only reveal themselves at the final stage. Saudi Arabia's post-oil pivot is proving that history isn't destiny. Strong fiscal foundations, social reforms, and strategic investments have moved the country from theory to action, though risks remain. So far, the skeptics were wrong, but only time will tell if the experiment fully succeeds.